With mortgage rates climbing higher than they've been in decades, the skyrocketing cost of living and political instability has everyone on edge. Jim Rickards has been sounding the alarm about what he predicts will be an explosion in the housing market like we've never seen before. But what does this explosion really mean? Rickards has long predicted an economic collapse that could rival or even exceed the 2008 financial crisis. He's been forecasting what he calls a 50% market crash, in which the US stock market could lose half its value. Imagine the rippling effects this would have on investor confidence and, by extension, the housing market. Whenever people lose their wealth, their first instinct is to stop spending. And more often than not, one of the biggest expenses that gets cut is housing. But you see, the stock market isn't the only issue. Rickards warns of a silent but deadly threat, which is the devaluation of the US dollar. With federal debt exceeding $33 trillion, foreign nations are reconsidering their reliance on the dollar. Countries like Russia and China are now exploring alternatives, and as the dollar weakens, import prices will continue to rise. What this means for housing is that the cost of building materials like lumber, concrete, and steel will skyrocket, making homes more expensive to construct and purchase. There's also the Federal Reserve, which Rickards argues has backed itself into a corner. In the bid to combat inflation, the Feds have aggressively raised interest rates, and this has pushed mortgage rates to higher levels than have been seen in decades. For a 30-year fixed-rate loan, buyers are now looking at an average of 7.5%. Now compare this to the historically low rates of just 2.75% a few years ago. What this means in real terms is that for a median-priced home of $416,100, monthly payments have jumped from $1,700 to over $2,800. This is an astonishing 65% increase. Can you imagine how this affects the average American family? For many, the dream of homeownership is slipping away, replaced by the harsh reality that only 20% of US households can now afford a median-priced home. That's down from 40% just 5 years ago. But Rickards doesn't just talk about numbers. He talks about people, the families that are now forced to make hard choices, the investors trying to stay afloat, and entire communities struggling to adapt to this change. One of the most important trends he highlights is the migration patterns that emerged during the COVID-19 pandemic. Urban centers like San Francisco and New York, once considered the crown jewels of real estate, saw property values decline by as much as 20%. The reasons for this are quite obvious. Well, aside the fact that many people sought to avoid crowded cities and the risk of the virus, high crime rates, remote work trends, and an overall exodus of residents seeking more affordable and safe places to live have become the order of the day. However, suburban and rural areas, on the other hand, especially in states like Texas, Florida, and parts of the Midwest, saw property values rise. Rickard has also pointed out the role of political instability in shaping the housing market's future. He predicted that the 2024 US presidential election could be a major turning point. With the country already deeply divided politically, he warned that the election might spark widespread unrest like protests, civil disobedience, and possibly even martial law. If things were to escalate to this level, the impact on the housing market could be grave. Urban centers, which have already seen a sharp decline in property values, might face even greater losses as people would be inclined to leave cities in search of safer, more stable living conditions. But even in these seemingly safer suburban markets, the situation isn't entirely rosy. Limited housing inventory in many of these areas means that demand is exceeding supply, which is naturally driving up the prices. This presents a paradox that while some regions may experience an increase in demand, others will have to face significant challenges as affordability continues to plummet. Rickard sees two possible outcomes for the housing market, and both are quite risky. The first is what he refers to as a market explosion. This is a scenario where wealthy investors, who are looking for safe havens in uncertain times, pour their money into real estate as a hedge against inflation. What would end up happening in this case is that individuals with high net worth will drive up demands in prime locations, and this will further intensify bidding wars and inflate property values in high-growth areas like Austin, Miami, and Nashville. This would then create a housing market where only the wealthy can afford to buy, leaving the rest of the population stuck in rental markets, or worse, without a home at all. On the other hand, Rickards also warns of a market contraction. This is a scenario in which rising mortgage rates and declining affordability will suppress demand among middle and low-income buyers. When fewer people are able to afford homes, we would possibly see a rise in foreclosures, especially in areas where the economy is vulnerable. As more homes hit the market, prices would drop, leading to a crash in the housing market. And this will inadvertently affect low-income house owners who bought during the boom. However, Rickards offers a few pieces of advice for those looking to invest in real estate. Firstly, he suggests focusing on tangible assets. Buying real estate in high-growth areas could serve as a safe haven against the dollar, especially if inflation continues to rise. Rental properties could also become more valuable as home ownership becomes increasingly out of reach for many Americans. When fewer people can afford to buy homes, the demand for rental properties will surge, and this will create opportunities for investors willing to take a longer-term view. Rickards has also emphasized the importance of diversifying. A mix of real estate, gold, and cash reserves could help protect you against the risks of a collapsing house market. After all, if there's one thing history has shown us, it's that real estate markets can swing dramatically in both directions, and those who are best prepared for uncertainty will be the ones who come out on top. To further explain this, Rickards has drawn comparisons between the current situation and the 2008 financial crisis. While subprime lending isn't that much of a concern today, rising debt-to-income ratios and the growing gap in affordability are some clear warning signs. The Case-Shiller Index, which tracks home prices, shows that there has been a price increase of over 40% since 2020. This is a clear warning sign that the market may be overheating. As we've already seen in the past, when home prices outpace income growth, the risk of catastrophe becomes very real. But it's not just about housing prices or market trends. An explosive housing market can lead to really profound social implications. Rising rents and foreclosures will push more Americans into homelessness. This crisis is already visible in cities like Los Angeles and Seattle. As the gap between the wealthy and the rest of the population continues to widen, social unrest will follow, and this could further destabilize the market. For those of us looking to protect ourselves from impending doom, Rickards has offered some practical advice. Lock in a fixed mortgage now, as this will provide some protection against rising interest rates. It is also important that you invest in properties that have strong rental demand, especially those close to key amenities like schools, healthcare, and jobs. Also, keep an eye on government interventions, like stimulus measures or changes in interest rates, as this might help you stay afloat in the turbulent waters ahead. The future of the housing market is very bleak at this point. With economic, political, and social forces influencing the tides, the possibilities are simply endless. Whether the market contracts or explodes will largely depend on how these factors play out in the coming months. Our key takeaway from Rickards' warnings is that preparation and adaptability will be extremely crucial. Whether you're an investor, homeowner, or just someone trying to navigate these uncertain times, the key is to stay informed and make strategic decisions. As we look ahead, one thing is for sure: the housing market of 2025 will look very different from what we see today. However, we must keep in mind that the choices we make now will determine if we stay afloat or sink in this coming storm.